Alrighty, so in today's video, we're going to make it nice and simple, ideally under 10 minutes, and we're just going to be going through what is the silver bullet strategy by ICT and what are some things you can look for, right? So what we're focusing on is ICT's silver bullet strategy. Now, what does silver bullet mean? Silver bullet just refers to a time period, right? Now, there's different silver bullets depending on if you're trading Asian session, London session, and so on and so forth. Today, we're going to be doing the New York silver bullet AM session, right? And that's from 10 o'clock in the morning, New York time, to 11 o'clock in the morning, New York time. So you're looking for trades in that time frame. You're either looking to execute in that time frame or you're looking for the setup to form in that time frame, and then you can execute slightly after. That's how I see it. So three things that you need for the silver bullet. You need a rate of liquidity. That's the first thing. Think of liquidity like taking out swing highs, swing lows. That's liquidity. Liquidity rests at old swing highs and old swing lows. So we need a rate of liquidity. Then we need a market structure shift. So it's technically a three-step process. So we need to take out liquidity. We need a market structure shift. And then we need a entry from a fair value gap. Now this is the most basic silver bullet entry model. So this is what ICT has dubbed the silver bullet strategy. And what we're going to do is we're going to actually outline this here. And we're going to go, okay, vertical line from 10 o'clock, right? 10 o'clock here to 11 o'clock. Cool. So I'm going to talk through some things as we kind of go through. What I want to point your attention to is at 10 o'clock or before 10 o'clock, have we rated any buy side liquidity? Have we rated any swing highs? And the answer is yes. We have taken out this swing high here. And I want you to zoom back as well. So when you're looking at the silver bullet, look what's happened from 9:30 to 10 o'clock. What that's referred to, so 9:30 to 10 o'clock. You could call that just like market open. Session open, right? So whatever happens there is important. And there's a key time frame between 9:50 a.m. and 10:10 a.m., which is called a macro, which we'll talk about more. In that macro time period, which comes in this time period here and also in this time period, we're looking to see what's also happened there. So let's have a look. From 9:30 to 10, we've taken out or we've rated this high. And all I mean by rating is we've taken it out, we've breached past it. If I zoom back, notice at this point, we've also taken out this high here. Now this high, if you have a look, we've taken that out right here. So we took out this high from the day before. This is Wednesday. This is Tuesday. Now, notice this high, there's no more highs around that. So it's a pretty significant high, and that's actually from the PM session. So that's from 2:36. This high is from 3:45. So we've taken out most of the buy side liquidity. So that's an important thing too, right? So right here, we've taken out yesterday's PM session high. So we've actually satisfied already this first thing. Now we're looking for a market structure shift. A market structure shift is displacement past a swing low. Now, this right here is 10 o'clock. If you want to enter right on 10 o'clock, that's completely okay. But if you want to enter a bit later, we'll talk about how you could do that too. You could class this as your market structure shift. Now, ideally, the candle that has the market structure shift, you want that to have a fair value gap. So you can see if that creates the market structure shift, that's your fair value gap. And if you have a look, we need to enter from the fair value gap. So you can see this entry is right on 10 o'clock. So if you're looking at the price and you already knew that we've rated liquidity, we've taken PM session highs, we've rated internal buy side liquidity. Now we've had a market structure shift. You could enter from here, but let's say you didn't enter from there, you want to wait a bit more, then that's fine. You can class this as your market structure shift, and you can enter from this fair value gap here, right? So two positions, one going short from the start of that fair value gap, and what ICT says is put your stop loss above that previous high, either this one or this one, right? Whatever works for you, and target the next level of sell side liquidity, which depends what you want to do, right? That's technically the opening range liquidity. So 9:30 to 10, you could, move your stop loss to break even here if you wanted to. You can target these lows, You can target these lows, you can target these lows. So you've got opportunities to target, right? Now, I think something that's missed out in all of this is what's important in terms of the rate of liquidity. And I'm going to add to this, right? What you're looking to be rated is this: London highs and lows. If you rate London highs and lows and then have a reaction off that, that's a good thing, right? That's the first thing. The second, if you take out previous day, so if you take out previous day, AM or PM session, highs and lows. So that's what's happened here. We've taken out the PM session high, and then we've had a reaction off that. And then we've taken out the internal high, and we've had a reaction off that. So in terms of rates of liquidity, you're looking for those two things in New York session. You're not just looking for any rate of liquidity. So for example, like you can't just say, well, how could I frame this? Say for example here, right? You can't just go, oh, okay, this is the silver bullet. We've taken out this high here. We've had a shift in market structure past this swing low. Let's have a look here. We've had a shift in market structure past this swing low. There's a fair value gap I'm going to enter from right here. See this little one here? And then you enter that, you put your stop above that high, you try to target the lows, but you get stopped out. So it's important liquidity that has to be taken in terms of placing trades. That's probably an important point. So you need to take out important liquidity. The market structure shift, for me, right, has to have some kind of displacement. Has to show unwillingness to continue higher. So in all this section here, so we rated this PM session high. I wouldn't class this, I wouldn't class that as a market structure shift, because we've got one wick here, right? You can see the wick. Then the next candle, the body just barely closes beneath it, and then we start to work our way back up again, right? And plus, even if that's a market structure shift, that fair value gap is not in a good zone. You want to be buying above 50% of that range, which we'll talk about in most cases, right? In most cases. But that's what I'd say. So you need some kind of important liquidity. You need displacement, and you need a fair value gap. So that could have been your first entry. This could have been your second entry. But what I want to talk about is, well, where do you target? Like, what are your targets? What should you target? I guess it's a good point, right? Because yes, you might enter, but it's happened to me before where you enter, you're targeting a swing low, swing high, but it goes down a little bit, but then you get messed up and it comes back and takes you out of break even. Target, same thing. You've got the market open range. So you've got any highs or lows from 9:30 to 10 a.m. That could be your first target. You've also got London session highs and lows. And you've got previous day highs and lows. It just depends where the market is sitting. But I'll tell you in this example, it's the London session lows that are the most prominent and the most important, because I just want to point your attention to this. And I made another video on this as well, but if you have a look, notice how we're just stepping up in London session. See that? Below each of these swing lows, there's low resistance sell side liquidity. And that is a perfect example of what ICT calls trendline liquidity. So when you're targeting things, you want to target, I guess you want to target where retail traders will have their stop loss. And retail traders will have their stop loss below any of these lows. And you can see, even though we get this accumulation, we take out all of that. We take out all of that eventually. So even if you got a late entry from this fair value gap, you could still target, one of these lows down here. And this is London session low. So London open starts at 2 a.m. So from 2 a.m. to 5 a.m. is London session. If you can target any lows from like 2 to 3 o'clock and they're sitting like this, perfect example. I wouldn't muck around here. Once, if you're in that job there, if you're in that entry, you might have taken some partials down here, and then you just got to wait, right? Your stop loss will be a break even. Eventually your take profit gets hit, and then you can see we start to move back up. So that's a 10-minute video just explaining what the ICT silver bullet strategy is, right? It's a rate of liquidity, but important liquidity, a market structure shift with displacement, a fair value gap, ideally where that market structure shift happens, and then you enter from that fair value gap, stop loss at the previous high, swing high, and you target important points of liquidity like I've mentioned there. So if that helps, let me know, and I'll talk to you guys next time.